Hello and welcome to Compass Global Markets Weekly Update. I'm Tony Boyajian. We'll kick off and talk about the European markets today. European share markets rose after the announcement of a formation of a grand coalition government in Germany. That has seen political uncertainty ease. However, the Italian general election outcome has led to a creation of a hung parliament, which means it'll probably be like a German-style outcome. They'll look to create a coalition government in coming weeks, as no one party has enough votes to gain a majority in the lower house. Now, what we've seen is frustration from the Italian public in general because of their inefficient and bureaucratic system of government. Italy has an unemployment rate in excess of 11%. It's rife with tax evasion and also a lack of economic recovery, which has seen the euro-dollar stay in a stable range, and we expect that to be the case. However, Aussie-euro is at fresh two-year lows. It's around that 62 level, so keep an eye on that. Elsewhere, we've seen the US dollar fall, and we've also seen that fall in response to President Trump's announcement that, or proposed tariffs, if you like, and this issue of protectionism has reared its ugly head again as the concept of trade wars return. Now, we're expecting that diplomacy will take over and they will dilute the imposition of these tariffs and perhaps even renegotiate the NAFTA with Mexico and with Canada, as trade wars will likely do nothing but instigate retaliation, and that could also cause a slowdown in global growth and global trade and also push US economic growth lower. So they'll try and avoid that situation and see if they can renegotiate the NAFTA instead. Now, the US is the world's largest steel producer and importer, I should say. They import 30 million tons of steel every year, and Canada and Brazil are the leading countries in that front. China is ranked 11th. So we're still expecting the US Federal Reserve to raise interest rates 3 times this year on the back of the strong wages and jobs growth that they've seen over the past few months. Elsewhere, we've seen the Japanese yen strengthen around about 5% just over the course of the past month. The Japanese yen is bought because Japan has a current account surplus, and in times of global uncertainty, it's a safe haven currency. Now, that's seen the US dollar weaken to a 15-month low against the yen, and the Aussie yen is around 1-year lows, around this 82 level at the moment, but on the technical charts, it looks like it can retest that 78 low. Locally, domestically, the focus will be on tomorrow's GDP figure for the fourth quarter. Australia's GDP report card is an important catalyst for the market going forward. The forecast is for a rise in GDP of 0.5% or an annualised figure of 2.5%. Now, that is sub-trend. It is a little bit weaker than expected, and it's constrained by this downturn in home building, weak consumer spending and low wages growth, which we've spoken about before. So we could see the Aussie-US weaken further this week, especially if we see a slowing in the net exports number. We saw a very weak capex figure printed last week for the fourth quarter. Look for the Australian dollar to remain in a 77-78 cent range for now, but the downside does look certainly vulnerable. Given Australia's benign inflation outlook, the weak consumer spending that we've spoken about and softening housing markets, we do not expect, and the market does not expect, a 25 basis point Reserve Bank rate increase in Australia until May 2019, so nothing for 2018, and wait another year or so before we get rate rises. That's the concept in the market, that's the current pricing, and that's the reason why we're seeing the Australian dollar remain subdued. Thanks for watching. Don't forget to watch us every Thursday lunchtime on Sky Business News Channel around 12:15 to 12:30 p.m. for our latest financial markets wrap. Have a great week. I'm Tony Boyajian.